Our guest says that as more earnings roll in for the fourth quarter, it's obvious that tariffs are starting to impact management outlooks. Let's get more now on this threat from Matt Orton, Chief Market Strategist at Raymond James Investment Management. Thanks very much indeed for coming on the show.
Hey, Andrew, it's always great to join.
Your read is that tariffs, the threat of a trade war, weighing heavily, more heavily on CEOs' minds right now?
Yeah, you know, Andrew, I think that's a good point. It's more heavily. I wouldn't say that tariffs are being viewed as that they're going to immediately negatively impact where earnings are going to go for these corporations, but it's something that's on the mind of management teams. And we're seeing the description or the use of the word tariff through earnings transcripts really used the most during Trump's first administration. What I try to look at and remind a lot of investors, though, is at this point, it's a lot of noise. Management teams are not taking their guidance down. Management teams are not making significant changes to their businesses right now because so much is unknown. And right now, earnings are very strong and guidance overall has been very strong. So investors just need to stick with it and try and tune out a lot of the noise.
And you say that the blended S&P 500 earnings growth rate for Q4 has been north of 16%?
That's right. The S&P 500 earnings growth has actually been quite strong. And what's most encouraging to me, Andrew, about the earnings growth is that we're seeing this continuation in breadth that we've talked about for the past couple of quarters. But that breadth is finally translating into increased price breadth, which is another reason why I'm optimistic about the market continuing to move higher, even without the big support of the Magnificent Seven companies and some of the big AI trades that have worked and buoyed the market in the past.
What about the US dollar? Maybe we can put up a chart of the dollar index because it does make it harder for US exporters, a high US currency.
It does. And the dollar is an issue. The strength of the dollar we are seeing described more and more on management calls. It's actually impacting the guidance of some larger multinational corporations. And it's one of the reasons why, as we headed into this year, a big part of my outlook for 2025 was increasing overall diversification. So that includes looking not only across sectors and industries, but across market capitalizations and geographies, and being very, very specific about where you have exposure, because right now selectivity and investing in idiosyncratic work, that's what's working right now. So you want to identify companies that have high quality accelerated earnings that may not be as impacted by the rise of the dollar, which leads me to financials, global banks. Those have been really key areas of strength, not only in the US, but around the rest of the world, Europe and Japan in particular. And I like leaning into that trade, especially as US deregulation should support that. More M&A, all of that's going to be supportive for their earnings profile going forward. And financials are actually the top contributor to earnings growth for the S&P 500 this quarter.
Let's have a look at a few one-year charts maybe for NVIDIA and Meta and Apple and Alphabet. Because you say one-year chart should bring it out. You say there are signs that these so-called Mag 7 stocks are beginning to break down or at least lose momentum.
Yeah, the technical picture isn't as encouraging. I think Meta is a little bit of a differentiated story given their business mix. And I would actually argue Alphabet, even though the chart isn't as great given the investor reaction to earnings, there's still strength there. I think what it shows, though, is that investors right now, given the uncertainty from DeepSeek, which long-term I don't think ultimately derails the AI story, there's still hesitancy. And so what investors are seeking in this market right now is better valuation with an earnings growth story. And that's why you're seeing parts like financials and in Meta, for example, actually working very well on investors diversifying away from just the AI trade.
Is there a foreign market or a non-US market that you particularly like the look of right now?
I mean, European banks, like I mentioned before, that's an area of strength. I don't like looking internationally from an index perspective because selectivity has to be important. The macro picture in Europe is questionable. Japanese earnings have to actually deliver to hopefully the economic strength that we're starting to see, the BOJ rate hikes benefiting parts of that market. So I want to be very specific with overseas investing. But One area of opportunity outside of banks in Europe that I think looks interesting from a tactical perspective is the weakness in India. The Indian market has sold off by almost 15% on growth fears and worries about earnings and valuation. We've seen a significant valuation contraction, and we're starting to see higher quality companies that have good earnings growth be rewarded. So I think now's the time to start looking at building a position when we start to see some signs of life, and if we get a little bit of dollar weakness, because that will benefit emerging markets overall.
Leave us with a final thought. Cisco, let's put up Cisco stock. Cisco, of course, has been around as a tech darling. Well, it was back at the turn of the century. The market reasonably pleased with the latest earnings, and the stock up almost 29% in the past year. What is your take on Cisco? Is it a buy right now?
Yeah, it's a buy, Andy. I think earnings were great. When you look at it, it's a beat on earnings. It's a raise with respect to guidance. And Cisco, it's a networking infrastructure company. And what you're seeing a lot of IT spend go towards isn't necessarily all of the AI applications or investing in the next generation of that. It's just getting their companies able to have artificial intelligence available to their employees. So what does that mean? It means more investment in networking software so that their ability to provide that to employees and their systems overall is there. So that's why I like the long-term trend for Cisco. It's a nice chart. Earnings have been good. It's been beaten raises. Analyst expectations are moving higher. So I think that's a story that you can lean into. It's tangential to AI, but it will benefit from its growth overall.
Thank you very much, Matt. You covered loads of ground.